Hey, well, welcome back. It's another one in our series of these ACCA paper P4 and one of the lower papers as well, videos. We are looking today at what your old examiner used to call the traditional net present value. And I have to be honest, I wasn't really sure what to call this. Well, what this is it's another in our series of these theories. So we started off, if you remember, with portfolio theory, and we saw how portfolio theory grew into capital asset pricing model. Then on the other side, and that was looking at risk and return and equity shares. Then on the other side, we saw how we had Modigliani and Miller and their theories on capital structure. Now what happens is that we're going to bring those two things together. So Modigliani and Miller are going to meet capital asset pricing model. Right, as far as the exams are concerned, this is very, very important now. As we go through these little videos, they get more and more important as the probability rises that it will be in your exam. And what's going to happen to you is you're going to use these things to calculate a discount rate, and that's where net present value comes in. So you're going to do a cash flow, then you're going to do what we've got in this video, that will give you the discount rate, and then you will discount the cash flow, and on the basis of that you will make a decision. So we have traditional net present value, we're calculating weighted average cost of capital, which will be our discount rate. We are doing that using a combination of Modigliani and Miller and capital asset pricing model. Then you're going to discount the cash flow. Right, I hope that's clear. It's very difficult to think of a title to sum all of that up. But and for those of you who are watching me for the first time, welcome to the series. My name's Mark. If you go onto our website, you'll see that there's now we've got 30 videos or something on the website, of which about 10 or so now are based around ACCA. So let's move on. So let's look at the slide then. What's going to happen to you in the exam? This is probably going to be question number 1. So it's going to be a big case study, lots of big chunky marks for this. As far as exam technique is concerned, it's really important that you get through the cash flow as fast as you can. So really don't get too stressed about the cash flow. If you make mistakes, it doesn't matter. Certainly the previous examiners gave nothing for the cash flow. And when I say nothing, I mean it wasn't nothing, but it was like, 4, 5, 6 marks or something. So if there's mistakes in there, it doesn't matter. Where your big chunky marks are is for the calculation of the discount rate, and that's really what your focus is. And I actually recommend that you go to your exam script and you do the calculation of the discount rate before you do the cash flow, because the cash flow just carries no marks at all relative to the amount of time that you've got to spend on it. Now there's various ways to do this, and we're going to come on in a later video to look at the adjusted present value, which is another of these theories. As I said, this is called the traditional net present value. You're going to be using CAPM, capital asset pricing model. I'm sure that people in universities will tell you that this is really, really popular and it's used all over the world. I've worked for banks, accountancy firms and corporate finance departments, never ever seen it used in real life. So learn it, use it on the day, and then you can forget about it afterwards. Alright, so what are you going to do then? The slide sets it out quite well, if I say so myself. We're going to calculate the discount factor to be used in an NPV. Right, you must understand capital asset pricing model and Modigliani and Miller before you start this. So if you haven't watched those videos, go to our website. It's an hour out of your life listening to me, sitting in this chair with a picture of my kids over my right shoulder, my right shoulder. But please make sure you're comfortable with them, because we're going to make a series of assumptions as we go through. And if you don't understand what Modigliani and Miller said, and you don't understand what capital asset pricing model is and does, then those assumptions aren't going to make sense. So get yourself a sandwich, kick back, and watch them for an hour. Focus on the assumptions, because the assumptions that they make will drive what we're going to do now. But in terms of understanding for the exam, as we go through these, they get systematically more important as well. So this is the key one. Right, so we're going to do this by using an example rather than teach you theory, because you should know the theory from the other two. So we get a company that's called Wyke, and they make ice cream in Scotland. I'm from Scotland, yeah. Right, they want to expand into Europe, blah, blah, blah. You can read the slide as well as I can. I suggest you turn my stand off and read it, to be honest, but go on, whatever. Market research shows that South Europe needs freezers. Obvious, isn't it? Greece and Spain and these places. Right, and we have a company called Arinaldi, and they are a Spanish firm that distributes freezers throughout the south of Europe. Wyke has prepared a cash flow. Right, in the exam you're going to have to do that, and in the exam it will probably be in euros or something like that if you're in south of Europe. So, Oh, coffee's so good, isn't it? So on the basis, please make sure you're comfortable with the scenario. This is a video, so you have to click back to it and stuff if you're watching it. And the video's on the website. That seems to work that well. Weebly, who run our website, are a bit crap, to be honest. Right, that's your scenario. So we've got these two companies that we need to know about. One is called Wyke, which is a Scottish company. They want to move into freezer distribution, which their market research has shown is a business that has a need or whatever. And they've identified a local company or a company that already does this, and they're called Arinaldi. Can you see, therefore, where this is leading you is that the examiner is going to give you information about Arinaldi, bringing together capital asset pricing model and Modigliani and Miller. Arinaldi will have an equity beta. Now, if you've watched please watch capital asset pricing model. You will know an equity beta is. The equity beta of Arinaldi will reflect the market risk of distributing freezers in South Europe, and it will reflect the gearing risk of Arinaldi's own gearing structure. And that's those two things you've got to get around your head. And it's really critical to this if you get the logic, because if you get the logic of what those two models are saying, it's actually easy after that. So Arinaldi has an equity beta that reflects the business, the market risk of being in the business of distributing freezers in South Europe, and also that beta reflects the gearing risk of Arinaldi. Now, Wyke needs an equity beta that reflects the business risk of distributing freezers in South Europe, but it also needs to reflect the gearing risk of Wyke's own business, or Wyke's own gearing. Yeah. So Wyke needs an equity beta that reflects the market risk of distributing freezers in South Europe and reflects the gearing of Wyke's own business. Okay? Right. Just say that to yourself out loud so that you get it clear in your mind. So what will happen is that within the text, and you're probably going to have to construct this table here yourself. So within the text, you'll be given certain information. You should use it to get some sort of table that looks like this. Now, I'm giving you it in a nice, neat form here. I'm not going to give you 2 pages of text to read. Your examiner's not going to be so nice to you on your big day. So we have an equity beta geared, right? You should know what that means. So we have Wyke. Wyke has the risk of, what does it do? It makes of the business risk of manufacturing ice cream in Scotland, and it has the risk related to the gearing ratio of Wyke. Right, Arinaldi has an equity beta which is slightly higher, 1.2. Now that reflects the market risk of being in the business of distributing freezers in South Europe. I think they're in Spain or somewhere around there. And also reflects their own gearing. Right, then we've got the gearing ratio, which is book values. DE is debt to equity, so there's Wyke is 50-50, 1-to-1, yeah, and Arinaldi is 3-to-7 on book values. Right, please remember, unless you have to calculate the actual amount of debt, that is irrelevant information. You always use market ratios or market rates. Right, gearing ratio, therefore, market value debt to equity in Wyke is 1-to-4, so debt represents 20% and equity is 80%. And Arinaldi is 50-50, so gearing much higher in Arinaldi. And then it gives you the cost of debt. When it gives you the cost of debt, assume that it's annual and assume that it's before tax. So if you put money in a bank account, they'll tell you you're going to get, at the moment, 0.5%. That's your annual rate before tax. Okay, you need to be comfortable with what those 4 things are. Certainly, number 1, the equity beta geared, the gearing ratio, market value, and the cost of debt is going to be something that you're going to need in the question. Right, hopefully you're happy with those, so make sure that you understand what they are, and I'll show you what you're going to do with them. Right, underneath it says assumptions. Your assumptions, and let's just have a look at what these are. Return on treasury bills is 6%, and return on the market portfolio is 9%. Right, I wrote this question, I've done it quickly, just looking at it, there's a little bit of a mistake there, isn't there? Because return on treasury bills really ought to be the same as what Wyke and Arinaldi are offering. So what that part of the question is telling you is that the risk-free rate is 6%, yeah, and the return on the market portfolio is 9%. Now your examiner will give you those numbers, so they're going to be in the question. So we could really have put them in the table above. So it's not really an assumption. You'll actually have to be told that. Right, the other two are assumptions or the other two relate to assumptions. The first one is that corporate debt is risk-free. Now, I'm very much hoping that you have watched the video on Modigliani and Miller, and that was an assumption of Modigliani and Miller. So unless you are specifically told otherwise, you should assume that corporate debt is risk-free. Now, in some of the questions the examiner will give you debt betas, and if you have a debt beta, that means that it's not risk-free. Okay. Now that's a very, very strange thing, because they tend to, Modigliani and Miller made the assumption, so if there's a debt beta, it kind of screws up their formula. But just assume, if there's no information otherwise, that corporate debt is risk-free. Modigliani and Miller did that, so you have to get the marks for it. Corporate tax is charged at 30%. You have to be told that. That's not an assumption. So we just assume that, well, you'll have to lift the number from the question. Here I'm telling you it's 30%. And the next part is the project will be financed in WIC. So unless, again, you're specifically told, because you have to use the project gearing ratios when you calculate your gearing. If you're not given any information in the question, just assume it's in the same ratio as the existing capital. The examiner has given you the project gearing in some questions and not in others. So go with the flow. Go with what you've got there. Yeah. But that would dictate to you what your gearing ratio is when you re-gear your beta. Right. You're going to get at least a page of information, so you're going to have to glean all of this stuff from the question. So try and construct a nice little table, keep the information clean, and if you write the information down like this and then make a mathematical error later, you'll get the marks anyway. So that's what we're looking for. Okay, right. So this is just a little slide that clears up what exactly it is that you're doing. What's happening is that we've got a project. The project is for the Scottish company which is going to distribute freezers in the south of Europe. You need to discount that, so you need a discount rate. Your discount rate will be the weighted average cost of capital. Okay, so that's an amalgam, and I'll show you how to calculate in a minute, but it's an amalgam or a weighted average of the cost of equity and the cost of debt. So we're going to start by calculating the cost of equity. Cost of equity will be given to us by capital asset pricing model. So you have your formula, you actually have the formula in the exam with you. I hope you've watched the previous video so you know what the damn thing is. Within capital asset pricing model, you need to get a beta. So the equity beta will reflect two things. Right, this is the equity beta for WIC distributing freezers in south of Europe. So that beta needs to reflect two things. One is the business risk of distributing freezers in the south of Europe, and the second thing it needs to reflect is the gearing ratio of the project. So, I hope you understand that we can't take WIC's equity beta as a starting point. We can't take WIC's equity beta as a starting point because WIC's equity beta reflects the risk of ice cream manufacture in Scotland. So what we do, therefore, is we take as a starting point our Rinaldi's equity beta, because that will reflect the risk of distributing freezers in south of Europe. The problem that we have with that beta is that it also reflects the gearing ratio of our Rinaldi. Now, from your table, you've seen that their gearing ratio is different. So what you have to do, therefore, is you have to take out our Rinaldi's gearing, and that will give you a thing called an asset beta. Now, your asset beta is simply a beta that reflects market risk and only market risk. So we will calculate this asset beta for the business of distributing freezers in the south of Europe, and then we will put into it WIC's own gearing ratio. So we will re-gear the beta. So we take our Rinaldi's equity beta, take out our Rinaldi's gearing, and put back WIC's gearing. That will give us a beta which reflects business risk, distribution of freezers in Spain, and reflects WIC's, or the project's, gearing ratio. That gives us the cost of equity. We then combine that with the cost of debt, and it will give us the weighted average cost of capital. Watch, and you will see how we do this. Right, just one thing to say is you need to understand the logic of what we're doing. Once you understand the logic of what we're doing, it's actually very easy. So, logic. Remember what we're doing. We are calculating, first of all, an asset beta. And an asset beta is a beta which reflects only the market risk of freezer distribution in Spain. We do that by taking Arinaldi's equity beta and taking out Arinaldi's gearing. Because remember, your beta reflects market risk, and remember what Modigliani and Miller said. Modigliani and Miller said that cost of equity is a direct proportion, or is directly affected by your gearing ratio. So if you look on your formula sheets that you'll have in the exam, but if you haven't got any book to do, you can Google this ACCA paper P4 formula sheet, and you'll see that BA is the asset beta, and it is the equity beta, so this beta thing with an E next to it is the equity beta multiplied by VE, where VE is the market value of equity, and then you've got VD is the market value of debt, and we multiply that by 1 minus the tax rate, take out the effect of the tax. BD is a debt beta, and we multiply it by the market value of debt, blah, blah. You can see the formula, so please read it. VE, market value of equity, plus market value of debt times 1 minus T. Right, if debt is truly risk-free, then your line will be a straight line. Yeah, your cost of debt will be a straight line. As remember back to the video from Modigliani and Miller, as gearing ratio rises, the cost of debt won't rise because it's completely risk-free, so no relation. So your debt beta will be 0. And that's why when you look below, you'll see that the whole second half of that has disappeared. So if we can make the assumption that corporate debt is risk-free, the second half of that disappears because the beta will be 0. The beta measures how the return changes as the risk changes. Well, the risk doesn't change, so the return doesn't change. It's risk-free. If the examiner gives you a debt beta, then you have to put the debt beta in here and use it as well. Okay, so in our question here, we have assumed corporate debt is risk-free, so the second half of the equation disappears. Arinaldi's equity beta is 1.2. That is back in your slide in the table. And it tells us that the market value, gearing by market value, is 1 to 1. So therefore you'll see that VE, the market value of equity, is 1, and down below market value of equity is 1, plus, and then we get 1, yeah? But the market value of debt is 1 as well. Right, the tax rate is 30%, so you'll see down there you get 0.7. 0.7 is 1 minus the tax rate. Okay, so market value of equity is 1, market value of debt is 1, but we have to pick out the tax, so we get 0.7. The market value, the equity beta of Arinaldi geared from our table is 1.2, so multiply through the numbers and we get 0.71. Right, what does 0.71 tell us? That is the asset beta, so it's a beta which reflects only the risk of distributing freezers in the south of Europe with 0 gearing. So we are assuming now that our business is totally ungeared, an ungeared company, as Modigliani and Miller would call it. Okay, right, so now we have an asset beta. What we're going to do on the next slide is we're now going to put White's gearing back into that. Okay, so your asset beta is 0.71. I strongly suggest you get a calculator and check that number as well. I get these things wrong all the time. Okay, final slide. So now what we have to do is we have to put into this White's own gearing. So going back to your table, wherever your table was, you were told that White has 20% of its capital in the form of debt and 80% in the form of equity. So it gave you the gearing ratio of 4 to 1 or 1 to 4 debt to equity, whatever the table said. But those are the numbers. So go back to the table, make sure you're happy where they come from. Therefore, what we really want is the equity beta, which reflects the gearing ratio and which reflects the market risk. So using our formula again, remember corporate debt is considered to be risk-free, whether it's in Spain or whether it's in Britain or America. So therefore, your asset beta is 0.71. That's what you've just calculated. Your market value of equity in White is 4. Your market value of debt is 1. We take out the tax rate. The guy will give you one tax rate, so assume that the tax rate is whatever it is in Spain. Yeah, and so therefore, putting our numbers in, we get an equity beta of 0.83. Right, just make sure you're comfortable where all of those numbers come from, because they come from your table, yeah, which is slide number, I can't remember, slide number 3, something like that. So go back and have a look at that slide, make sure you're happy where those numbers come from. That will give you an equity beta of 0.83. Now the question is that most students actually fine up to there, and then what happens is they go, so what do I do with it? Right, well that is your beta, so you put it into capital asset pricing model, and you calculate what is the cost of equity. So the next line you'll see there that starts with KE equals 6, that is just simply capital asset pricing model. So we take the standard formula. I've got to be honest, you really should know this before you go into the exam. If you're going to pass this exam, that should be something that you don't even need to look at the formula sheet for. But you will have it on the formula sheet. So the cost of equity is equal to 6, which was our risk-free rate, which again I said was a bit strange because we've got corporate debt here at 4%, but whatever, go with the flow. 6%, and then plus 0.83, that's your equity beta, multiplied by 9 minus 6. 9 being the return on the market portfolio, and 6 being the risk-free rate. Multiply those numbers through, and you should get that your cost of equity is equal to 8.5%. So we get KE equal to 8.5%. Good so far. Right, please, this is actually the biggest mistake that students make with this, and it's usually just like 1 mark at the end they lose for it, is that students assume that that is your discount rate. It's not. That will only be your discount rate if your project is going to be 100% funded by equity, but it's not. It's going to be funded by equity and debt. So therefore you need to calculate the weighted average cost of capital. It's a simple weighted average. So we said that 4 parts out of 5 were equity, so it's 8.5% times 0.8, and then your risk-free rate. Here we're using the risk-free rate. I would certainly take, if I was marking this, that you want to use White's own cost of debt, which from memory is 4%, 4.5%. 4, isn't it? It must be 4 because it's in the formula above. So therefore, if you want to use 4 times 0.2, that's absolutely fine as well. You can do that. If I remember, it gives you the same answer. So here we've got 6%. If you want to use 4, that's okay. But your weighted average cost of capital is equal to 8%, and I've shown it in red. I think if you multiply through, you'll get some number. If you get, 7.632 or something, don't use that. Don't try and do the whole damn thing, especially if you've got yearsies. Round it to the nearest number, then you've got your tables and use your tables, and you'll get the marks for it. The assumption at this paper is that you can't actually do a discounted cash flow. There's no marks for this. So you take the number that you've got and then you discount your cash flow. Once again, your big chunky marks are for doing this. There's very few marks for the cash flow. If you're going to fail this, then please spend an hour and a half doing the cash flow, because that's what students do. And they will get all 3 or 4 marks for that cash flow. But you really don't need to do that. Whack the cash flow out as fast as you possibly can. Many marks. There will be as many marks for the discount rate as there are for the cash flow. Okay, there you go. That's what your examiner calls traditional net present value. Before I put this up on YouTube, I'll probably have to change that, because anybody searching for this will not find it. So if you put traditional net present value in, so we need to think of a new name for this. But you can contact me through YouTube. You can contact me through the website. Go to the website. If this is the first video you're watching, then I suggest you really have to watch Modigliani and Miller and Kaplan before you watch this, or it won't make any sense. But have a look on the website. There's a whole stream of videos there. I need to put an index up. I think we've got that many now. Right, best of luck with the exam, guys, and contact me if you have any questions. Bye. We're sitting here in New York waiting for snow at the moment. Good luck.